Let's be honest, everyone loves the idea of money showing up without doing anything. You wake up, grab your phone, and boom, a notification hits. A company you invested in just paid you. It feels effortless, almost like breaking the rules of how money is supposed to work. No boss, no extra hours, no side hustle, just ownership turning into income. That's the emotional pull behind dividend investing, and it's powerful. But then there's the other side of the investing world, the quiet, almost boring strategy that doesn't promise excitement. No cash hitting your account every month, no instant gratification, just a simple plan. Buy the market, hold it, ignore the noise, and let time do the heavy lifting. No drama, no constant checking, just patience. So now the real question isn't just which strategy makes more money, it's which one actually works in real life, over decades, through crashes, fear, greed, and everything in between. Because investing isn't just math, it's behavior, it's psychology, and most importantly, it's what you can stick with when things get uncomfortable. So let's start from the foundation. When you buy a stock, you're not just buying a ticker symbol, you're buying a piece of a real business. And when that business makes profits, it has choices. It can reinvest that money to grow, pay down debt, buy back shares, or distribute part of that profit back to shareholders. That distribution is what we call a dividend. It's not a bonus or a gift, it's your share of the company's earnings. Typically, companies that pay dividends are mature, stable, and already dominating their industries. They're not chasing explosive growth anymore, they're generating consistent cash flow. That's why you'll often see dividend-paying companies in sectors like consumer goods, healthcare, utilities, and finance. These are businesses people rely on every day, regardless of the economy. And over time, some of these companies build a reputation for not just paying dividends, but increasing them every single year. These are often referred to as dividend aristocrats, and they represent consistency in a world that's anything but consistent. Now here's where things get interesting. When people first hear about dividends, they assume it's extra money, like a reward on top of their investment. But that's not entirely accurate. When a company pays a dividend, the stock price typically drops by the same amount. So if a stock is worth $100 and pays a $4 dividend, it may drop to around $96. You didn't gain $4 out of thin air, you simply received part of your investment in cash. This is one of the most misunderstood parts of dividend investing. The real advantage isn't free money. It's the structure of how you receive your returns. Instead of relying on price appreciation alone, you're getting a steady flow of cash, and that changes how you experience investing. It feels different, it feels more real, and that feeling can influence your decisions more than you might think. But you don't have to pick individual dividend stocks to build this kind of income stream. You can invest in dividend-focused ETFs, funds that hold dozens or even hundreds of dividend-paying companies. These funds collect dividends from all those companies and pass them on to you. It's like owning a diversified income machine. Instead of relying on one company to keep paying you, you're spreading that risk across many. And for most investors, that's a smarter and more stable way to approach dividend investing. Now let's talk about why people love this strategy so much. The biggest advantage is simple: income without selling. Imagine you're retired. The market drops 20%. If your strategy depends on selling shares to live, you're forced to sell at lower prices. That hurts not just financially, but emotionally. But with dividends, your income keeps coming in. Even if your portfolio value drops on paper, that creates a sense of stability. It allows you to ignore short-term market movements because your lifestyle isn't directly tied to selling assets. And that's incredibly powerful. It reduces stress. It keeps you invested. And staying invested is one of the most important factors in long-term success. There's also a psychological benefit that's hard to quantify but impossible to ignore. When you see cash regularly hitting your account, it reinforces the idea that your investments are working. It creates positive feedback, and that feedback loop can help you avoid panic selling during downturns. Because when markets crash, and they will most, investors don't fail because of bad strategies. They fail because they abandon good strategies at the worst possible time. Dividends can act as a behavioral anchor, keeping you grounded when everything else feels uncertain. But dividend investing isn't perfect. One of the biggest drawbacks is concentration. Many dividend portfolios end up heavily weighted in specific sectors like utilities, real estate, or consumer staples. These sectors are stable, but they're not where the fastest growth happens. So over long periods, you might miss out on companies that are driving innovation and expanding rapidly, that can lead to lower overall returns compared to a more diversified approach. There's also the issue of taxes. In many cases, dividends are taxed when you receive them, even if you reinvest them. That creates friction. It slows down compounding, and over decades, that small drag can turn into a significant difference in your final portfolio value. Then there's the danger of chasing high yields. A stock offering an 8% or 9% dividend might look incredibly attractive, especially compared to a typical 2 to 4% yield. But high yields often come with high risk. Sometimes the company is struggling, and the market is signaling that the dividend may not be sustainable. When that dividend gets cut, and it often does, the stock price can drop sharply. So what looked like a great deal turns into a loss. This is one of the most common traps in dividend investing, and it catches a lot of people who focus on income without understanding the underlying business. Now let's shift to index investing, the complete opposite philosophy. Instead of trying to pick specific companies or focus on income, index investing says, own everything. Buy the entire market. Don't guess which companies will win. Just own them all, and let the winners naturally rise to the top over time. This approach is built on a simple but powerful idea. Markets, over the long term, tend to go up. Economies grow, businesses expand, innovation happens, and by owning a broad index, you capture that growth without needing to predict anything. Index funds track specific market indexes, like the S&P 500. When you invest in one, you're instantly diversified across hundreds of companies. That diversification reduces risk. If one company fails, it barely affects your portfolio. And because these funds are passively managed, they have extremely low fees. That might sound like a small detail, but over 30 or 40 years, fees can make a massive difference. A 1% annual fee might not seem like much, but it can eat away a huge portion of your returns over time. Index funds, with fees as low as 0.03%, allow all of your money to stay invested and compound. Another advantage is tax efficiency. Because index funds don't trade frequently, they generate fewer taxable events. That means more of your money stays invested, growing quietly in the background. And historically, this approach has delivered strong results. Over long periods, broad market indexes have averaged solid returns, making this one of the most reliable strategies available. But here's the catch: index investing doesn't feel good in the short term. There's no regular income, no cash payments hitting your account, just numbers on a screen going up and down. And when markets drop, those numbers can drop fast. Without the reassurance of dividends, it can feel like you're losing money even if you're still on track long term. And that feeling can trigger bad decisions. Selling during a crash, trying to time the market, jumping between strategies. These are the behaviors that destroy returns. There's also the challenge of retirement. With index investing, you typically rely on something called the 4% rule. You withdraw a small percentage of your portfolio each year to fund your lifestyle. But that means selling shares. And if the market drops early in your retirement, those withdrawals can have a bigger impact than expected. This is known as sequence of returns risk, and it's one of the biggest concerns for index investors. It's not about average returns, it's about when those returns happen. So now we come to the real question: which strategy is better? And the honest answer is it depends on you, not your intelligence, not your income, not your ability to analyze stocks. It depends on your behavior. If you're someone who needs to see income to stay invested, dividends might be the better choice. If you value simplicity, diversification, and long-term growth, index funds might be the way to go. But here's something most people don't talk about. You don't have to choose one or the other. Some of the most effective portfolios combine both strategies. They use index funds for growth and add dividend investments for income and stability. This hybrid approach can balance the strengths and weaknesses of each strategy, because at the end of the day, the best investment strategy isn't the one with the highest theoretical return. It's the one you can follow consistently for decades, the one you don't abandon during a crash, the one that keeps you invested when emotions try to pull you out. That's what really builds wealth. Not timing the market, not finding the perfect stock, just staying in the game long enough for compounding to do its work. And that's the part most people underestimate. Compounding isn't exciting. It doesn't happen overnight. But over time, it becomes unstoppable. Small amounts turn into large ones. Consistency turns into freedom. And whether that journey is powered by dividends, index funds, or a mix of both, the key is to start. Stay disciplined and never let short-term noise distract you from long-term goals.